Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. This video is going to speak about high probability scalps. This model will also help traders find long-term setups on the higher time frame. With that being said, let's get into our disclaimer. Do your own research. My content is intended to be used for informational purposes only. Please do your own research before making any investment or trade based on the information provided, and consider your own personal circumstances. You can talk to a professional or do your own independent due diligence on verifying any information that you find on my channel. This is a message from myself, Deontay, as I am not a professional. With that being said, let's get into today's lesson. The higher the time frame, the easier it is to predict trend. The daily time frame is great for finding trending markets and the simplest draw on price. You simply have to ask yourself one question. Is price reaching for yesterday's high or low? The market operates in swing points. Whenever the market is ready to change directions, it will always do it starting with a swing formation. A swing low is a candle with a higher low on the left and a higher low on the right. A swing high is a candle with a lower high on the left and a lower high on the right of it. Let's look at an example of what a swing high looks like. We're looking at the DXY in the daily time frame. We can see that we have a swing high formation here. We have a candle with the highest high in the middle, and it has a lower high on the left and a lower high on the right. It only takes 3 days, or 3 bars essentially, for a swing high formation to form. It doesn't take 6 days or 4 days. It only takes 3 days. 1, 2, 3. As soon as you have a candle that is the highest in the middle and the highs on the left and the right are lower than it, that's your swing high formation. Now, this right here is the swing high. This point here, this key point here, 1, 2, 3, that's it. Your swing high is right here. Now let's look at what a swing low looks like. Here, we are looking at a swing low, and I'll box it out for you guys. So from here to here, this is a swing low formation. Now why is it? Because there's a higher low to the left of this candle's low, and there's a higher low on the right of this candle, making this point here, this candle here, the swing low. So we'll draw it out here. This is the swing low. And like I said, it only takes 3 days for the market makers to create these swing points. 1, 2, 3. Now what happens after we get these swing points? What should we be looking for? Well, that's what I'm going to talk about. In a bearish scenario, a swing high must form. After that swing high forms, we are tracking the third candle in that swing high. Next, wait for the third candle's low to be broken. From here, we look for selling opportunities on the candle's low that broke the third candle's low. Let's look at an example of what I'm talking about. We have a swing high formation that we defined earlier. So you have a high with a lower high on the left and a lower high on the right. Only takes 3 days or 3 bars for this formation to form. After we have this formed, we're waiting for this third candle's low to be broken. So we're stalking this. We're patient here. We're being disciplined traders. If you're following the model correctly, we're waiting for this low to be broken. That's it. Now, that does not mean the next daily candle is going to break its low. It's whatever daily candle breaks its low that we're going to be targeting. That's the last step. So let's see what happens after this. Price opens, rallies up, fakes traders in long, and then blasts through this low here. Now we have high probability odds on our end because we know that the market is most likely going to do what? Run this candle's low. That's your high probability scalp here. This candle's low, it's what's going to be rated. The odds of the high being rated is less favorable because we have this formation. When these formations occur, that's normally going to be signs that smart money is turning price around and taking it in a new direction. How will we look to target this candle's low? You may be asking yourself as an entry, how are we going to get that shorting opportunity the next day to get to this low? Well, there are many ways to go about it. The first one I'll tell you is the lazy trader's approach. You wait for midnight opening price and you sell above midnight opening price. So you wait till midnight, New York Eastern Standard Time, and you sell above that price point, which is going to be a premium because we know algorithmically the market likes to sell at higher prices every day. If it's bound or drawing for lower prices, it's going to make a early rally in the AM session, so like the London session or a little bit into the New York session. You're going to get a rally up to fake traders in long, and then what are they going to do? They're going to short. Now, the other way you can look at this is an AMD, so accumulation, manipulation, distribution, because you know how these daily candles form. We know that it opens, has a high point, runs, and then creates a low, and then closes off. So what could you be looking for? Maybe in high forming in London that next day, or looking for some type of bearish order block to trade the next day. And that's how you would simply try and get in short the next day to aim for the high probability scalp of this low. Because this candle ran the third candle's low, that's why we're targeting this candle's low. Does not mean that the next daily candle had to run this low. Because like I said prior, this candle could have just stalled in between the high and the low. But then the next one after could have broke the low. Whatever the candle that breaks this low is going to become your high probability scalp. Let's see how this plays out. Boom, a dynamic response to the downside. This low was a high probability run on sell stops. So that's a bearish scenario. Let's look at a bullish scenario. A bullish scenario is everything inversely to what a bearish scenario is. A swing low must form. After that swing low forms, we are tracking the third candle in that swing low. Next, wait for the third candle's high to be broken. So you can see on the left, I have an eyeball indicating that third candle's high. We're stalking that high. We send an alert there. Once we see that swing low formation, that third candle's high, we're just waiting. We're being patient. From here, we look for buying opportunities on the candle's high that broke the third candle's high. So let's look at an example of what I'm talking about. Here we're looking at a bullish scenario. We can see we have a swing low formation that we defined earlier. So there's a candle who has a higher low on the left and a higher low on the right, making this the lowest low in between the two. Takes 3 days. It only takes 3 days for this formation to form. Once we get this formation formed, right, we're stalking that third candle's high. So we set an alert here to see when it's tripped. Once this candle is tripped by whatever daily candle it is, maybe tomorrow, maybe the next 2-3 days, whatever candle that is that breaks this high, that candle's high is going to become our high probability run on buy stops, or a high probability raid on buy stops. Let's see how this plays out. Price runs this high here. Now this candle in itself becomes our high probability raid on buy stops. So the high is what we're going to be targeting. And we'll color code it. We'll make it gold because we want to signify it. This is the candle that's going to be the high probability run on buy stops. Now the next trading day, what are you going to do? You're most likely going to look for midnight opening price, and you're going to buy below midnight opening price because you're buying in what? A discount. And we know the markets like to buy, or prime to buy, in a discounted market. They buy at cheaper prices and then offer higher prices to buyers. That's how it normally works in the market every day. Or what you can do is you look for an AMD model, accumulation, manipulation, distribution. You're looking for Asian session to be tight the next trading day, or this trading day as it's forming, as it's coming to an end. And then you're waiting for London to make a fake move down, right? Making the low of the day and then rallying, and then New York session creating some type of optimal trade entry continuation pattern to the upside to take out this high here. Let's see what happens. So we're in long, but we don't get to that high. Do we get out of our trade? No, we're going to hold the trade because we know this high is still a raid or a high probability scalp that we're aiming for. It's still our target, so we're sticking to the model. We also do now have this high here that the market is maybe enticed to grab as well from an algorithmic standpoint. And then we press play and we see what happens as well. Boom, a dynamic response to the upside. Yes, I know, we do run the lows of these candles, but ultimately, where was the high probability of scalp most likely leading towards? The buy side, not the sell side. Now, where you put your stop loss may differ for you depending on your equity, but primarily what I would do is I'll place my stop loss previous daily low or the 2 days low ago. So essentially, if I was going long on this day, right, my stop loss would be below this low, right? And I didn't get there. Or my stop loss would be below this low or even the swing low here. Because if we know that this is where the institutions are turning the market around and increasing their net long positions, they don't want price to come back down to the swing low. Think about that logically. Why would they want the price to come back down here if that's where they're sponsoring price? If price were to return back here, most likely it's going to be a reversal and price is going to continue to the downside. So this is a bullish scenario. This brings me to the main concept of the lesson. This is an easy way to find momentum. Within these swing points, the swing lows or the swing highs, the market makers are increasing either their net longs or their net shorts. Locating these setups can aid with finding trends, meaning even after you find that high probability scalp on the buy stops of a high or the sell stops of a low, the markets can continue trending in that direction. Following this model can be beneficial to traders who cannot focus on intraday trading. Let me show an example of trending environments after a high probability scalp setup has played out. Here we're looking at US oil as our bullish example. We can see that there's a high probability scalp that's occurring earlier on in December 2020. After that high probability scalp occurs, you can see the market trends for several months after that high probability scalp. The momentum is being shifted within that swing low. The market makers or the commercials are increasing their net longs on oil at that point in December. I was actually able to capitalize on this ideology and I posted my results on TradingView. I'll leave a link to that TradingView post in the bio. Let's look at a bearish example. Here, you can see a recent gold example in March 2022. We can see that a swing high formation forms and we get that high probability sell model. After that model is formed, we can see that the market then trends for several months to the downside. As you can see, these high probability scalps can be just more than a raid on buy and sell stops of a previous daily high or previous daily low. It can help with those that are looking for higher time frame trends. That brings me to the end of this lesson. Hopefully you learned something new today. I'm going to leave you guys off with a quote. Once you know what failure feels like, determination chases success. Kobe Bryant. Thank you and peace.